Welcome to the CFA Society India podcast, where society members engage in conversations with industry experts to bring you unique insights. This podcast represents the views and opinions of the originally featured speaker and is posted with their express consent. The podcast is meant for educational purposes only. It should not be construed as research, recommendation, solicitation, or investment advice by CFA Society India. This episode is from the CFA Society India archives. Now, let's dive into today's episode.
Mistakes in Investing by Mr. Utpal Sheth. And it is my pleasure to invite Mr. Varun Goenka, Managing Partner and Fund Manager, ValueQuest Investment Advisors. About Varun. Varun, prior to joining ValueQuest, has been the co-fund manager at Nippon Mutual Fund. With experience in 20 years in markets on both research and fund management, he has focused on consumer, technology and light engineering industries. Can I request, with a warm round of applause, Mr. Varun Goenka.
Good morning, everybody. Am I audible? So, for me, it's a moment of, thank you so much, CFA Society. It's an honor to be here with Utpal Bhai. And for me, it's kind of a moment when the student is ready, the teacher appears. And it's truly a privilege to introduce Utpal Bhai to be here. I'll choose his own words to introduce him rather than going through the bio, which you can anyways access publicly. I would say most geniuses, especially those who lead others, prosper not by deconstructing intricate complexities, but exploiting unrecognized simplicities. These words were actually shared by Utpal Bhai himself a few years back, but it stayed with me, and this is exactly what he's able to do. And why is he able to do is what I'm here to share, which is probably lesser known and lesser discovered. So there are a few investors or people in the country. We now know, let's say, Radhakrishan ji because of the DMART IPO, Rakesh ji, of course, because of his media appearances and his being so vocal is known. But Utpal Bhai has been executing behind the scenes for last 20 years with RARE, with his firm Trust Capital, with an asset management firm Chanakya. So he's been far low key. It's just recently that he has made a few presentations, or let's say come on Wizards of Dalal Street by Ramesh ji, made the Mega Trends presentation at the CFA Society event at Delhi, is when actually people started discovering him in the last few years. But let me tell you, I don't have anybody come to my mind with such breadth and depth of experience, and let me elaborate there. I don't think so. There are many who can connect macro and micro the way Utpal Bhai does. Not many who've had such long public market experience, have done venture capital deals, M&A, buyout, private equity, and at such large scale as what we now know as outcomes like Star Health, Metro Brands, so many others. We know him for his Titan, and Shree Cement early identification, but there's a lot that is unknown. And today's discussion is also about an area which is far less articulated, either in academic or investing literature. I would invite Utpal Bhai to please come with further ado to really take us through what he's put together. We would be quite mesmerized or stunned because this is not often that we get to hear cross that bridge from knowledge to wisdom. So what Utpal Bhai presented to us, maybe some of us would have taken 20, 30 years to understand, and we are really fortunate and lucky Whoever is lesser than 30 is even more luckier. Some of us who are on the other side. So as they say, with great power comes great responsibility. I think such masters have the responsibility to share the learning, and I think what CFA Society is doing is not realizing the kind of impact and influence some of the early learners and us will have uh, by hearing these people, and so that we could really shorten our learning curve, really learn, and it would have a magnifying impact on our outcomes. So thank you so much, Utpal Bhai, for taking the effort to put this kind of a distilled wisdom is really, really rare. There's no book you can pick it up, or so I'm really glad to be here. I would not let him go without uh, a little peek into his personal life for 5 minutes. He has come from very humble beginnings himself, and rising to a stature of this level of experience, becoming partner and CEO at RARE, which is today the largest family office in India and probably one of the largest investors by absolute size. And he didn't stop there. He went on to create trust in Chanakya. So rather than the template, I would, Utpal Bhai, ask you, what is the kind of attitude that you lived, which allowed you this kind of an aptitude and altitude?
Okay, I don't know about the altitude, but let me talk about the aptitude. To me, two things were important: learnability and adaptability. So I always had this quest to learn, and I hope that I'll have it to my last day. I have just followed that quest, ensuring that it is not just an ivory tower learning, okay, that I'm able to adapt to what I learn and then implement that and execute that. And it need not always be right. Quite a few things which have not gone well for me, but I'm okay with that. And I have learned to be resilient. So I would say adaptability, learnability, and resilience.
So assume we have a hungry person wanting to learn. If you could guide us on how would you separate what is signal and what is noise? Again, it's something that we all have to evolve over time, but and you are doing so many hats at RARE, from public market, private equity, and your two founding firms. So at least from our point of view, which most of us are more public market facing, how do you really separate signal and noise, yet have room for controlled experiments? Some mistakes are bound to creep in, but what not to do is getting even more challenging, and then we will definitely come to some questions on the presentations.
So I would say simplicity is not that simple, right? And therefore, while in your mind I'm doing quite a few things, in my mind I'm doing only one thing, and that is learning, adapting, and being resilient. It's not easy to sift signal from noise, but at the same time, it's also not too difficult to focus on a few things. I think when you have internal clarity it's very evident of what you don't wish to do or what you should not be doing. Okay? And really speaking, there is no should not be doing, because something might work for someone else. You have to realize what works for you. So what you don't wish to do, you should be clear and derive everything from that.
Sure.
So, to my mind, that requires a lot of introspection and understanding yourself. As Gautam Buddha said, it is easier to conquer the world than to conquer the self. And I think that's very, very tough, and I'm not sure that I have done it well enough.
Right. I think that's a quality of anybody being in the market long enough, anybody done it at a certain scale. I think humility sets in in ways that. The slide that you showed on joint probability, something in tidbits we all know how difficult it is, but you have quantified and made us realize really how odds are against us actually. So let me ask you some black and white questions. If we feel that our assessment is correct and we have a higher probability on all those 5 or 6 areas, then what is it should be our allocation to begin with? A range of number or something, you know.
Allocation to one stock,
Yes.
where you
Yes.
feel that you got all of
Yes.
that. Okay. So people think about that decision at a point of time. You have that higher probability in your mind today. But today is not the last time that you are going to be making that investing decision. So, to my mind, depending on what your portfolio strategy is, you should have an opening position on that stock where it is not an insignificant stock in your portfolio. Okay? I'm emphasizing the word not an insignificant part of your portfolio. And then over time, as that conviction keeps getting validated and reinforced even more, you should keep increasing the weight, even if you're buying at a higher price. So, Rakeshi bought the first Titan at 32 rupees a share in those days. But we bought Titan even at 120 rupees a share, 140 rupees a share, 400 rupees a share, 900 rupees a share. So, don't think of your buying decision as one buying decision at one point of time. You know, in physics, there is this concept of space-time continuum. Same way, there is a continuum of returns and time. Whenever you feel that it's the price and the probability equation is in your favor, you should go ahead and enhance your weight.
Sure.
And I think even Michael Mauboussin talks of the same thing, probability adjusted investing.
Sure. Right, so no anchoring bias, obviously, of a starting point for sure. A lot of us could have got into Bajaj Finance probably when it had already become 10x or such, but still the runway was so long, right? So as you showed in the mega trends gorilla opportunity, would you say that there's a lot of research breadth now, but the depth is getting more complex by the day? To be able to assess management teams, a lot of outcomes in such a VUCA world. So where do you think is individual investing? There are a lot of individual investors here. Is the edge of individual investors diminishing in some way in favor of either institutional investors or professional team like yourselves, which are doing a very different level of depth in terms of work. Where do you think the scale is tipping towards?
Okay. So, Rakesh used to say that too much of analysis leads to paralysis.
Yeah.
Okay. So, I don't feel that there is anybody losing any edge because of too much information and so on. And your edge need not come out of greater degree of information. I think the whole markets are evolving from the importance of information to the importance of analysis to the importance of synthesis. Okay? Like we say that earlier search was important, now sift is important. Okay? Same way, from information to analysis to synthesis. But if you look at the distribution of the population of investors, only on one variable, which is time, then you will find everybody being concentrated on the 0 to 1 year.
Right. Yeah.
Very few concentrated between 1 to 3 years. And a minuscule minority concentrated between 5 to 10 years. So the moment you shift your time horizon to 5 to 10, you already have the edge.
Absolutely.
Right? The question is, do you have the focus and the discipline to shift your time horizon to 5 to 10? And Rakesh used to actually give us the freedom and the empowerment to think of even beyond 10. So I feel that he empowered us in so many ways, and every investor has the power to empower themselves to shift your time horizon. And then you don't have to think about edge.
Since we are on this time horizon, you have explained on terminal value really, really well in the past. You covered it in your previous Megatrends presentation also. If you could, since it was not covered in this presentation, do help, change in terminal value is even lesser understood. Terminal value is hardly, if you could really spend, this is something again where academia or investment literature really does not. Theoretically, accounting wise, it is given some due in that DCF, but really it's not given its due importance. And
true. I don't know how much time we have.
yeah, we have only 5 minutes. So
to elaborate on that. But, a lot of people say that their style of investing is growth investing versus value investing. And we say that our style of investing is terminal value investing. We are always focused on the terminal value. And I'm sure you've heard of the chaos theory, where the flipping of a butterfly's wings causes an earthquake somewhere.
Lorenzo effect, yeah.
Right? Any change in the terminal value has an outsized effect on the price. So one has to keep thinking not just about the terminal value, but also about changes in terminal value. And while very few people get the terminal value right, even fewer people get the change in the terminal value right. So we all talk about moats, for example, and competitive advantage. However, your best returns come from companies which are widening their moats and elongating their competitive advantage. So, there was this movie called In Pursuit of Happiness.
Oh yes, of course,
Right?
beautiful movie. Yeah.
I would say we are in pursuit of terminal value.
So the forum has added 10 minutes to your thing, added more terminal value, so to say. Yes, so change in terminal value could be driven by regulations or competitive. If you could share one case study of how either a positive or a negative change in terminal value was a decision making.
Okay. So first of all, let me clarify that once upon a time, terminal value used to be driven by intangibles. Somewhere around the time that I started my career, which is mid-80s, early 80s. But today, most of the terminal value and change in terminal value is driven by intangibles. It's far more difficult to understand intangibles and appreciate intangibles because you can't quantify it. It's not a mathematical formula. There are factors which contribute to terminal value, which I call as the 3 I's. One is inevitable, second is irreversible, and third is irreplicatable. Okay? When you find these 3 factors in different contexts, in any company, you can be sure that it will create terminal value. However, I will add that all of these are dependent on the culture of that company. Okay? Because you can replicate somebody's manufacturing process.
Yes.
You can replicate somebody's distribution strategy. You can copy a product. You can spend money on branding, but you can't buy culture. So culture is one of the largest intangibles. And I can give you stories after stories, but let me talk about our investment in Metro shoes. I'm not talking about Titan because it's been talked about enough. But Metro shoes, when we invested, as I explained to you earlier, we realized that this company is a near leader which will become a clear leader. But the culture that we saw in that company was phenomenal. There were various facets to that culture, but none captures that as well as one video of Rafiq Bhai addressing his staff during COVID times, which was actually never authorized. It was an unauthorized video which went viral subsequently, of how they have this culture of finding opportunity in every crisis, of never wasting a crisis. Okay? And it was that resilience, okay, that was truly inspiring. And what was the importance of that resilience? Every business will have cycles, but when a company like that faces a challenge,
Becomes stronger. Yeah.
it will become stronger. When all its peers and competition will become weaker, it will bounce back the first, and it will bounce back the fastest. It will bounce back the greatest. And that will keep creating value in every economic cycle. So there's this concept of creative destruction. Right? So this is the kind of company that will create even more value through every business cycle
Very rare.
right? Hence, I would say that your ability to find those companies and those cultures which will create value is most important. I don't know if that answered your
No,
question.
absolutely. And that actually, in some way, also says measuring culture requires the level of focus beyond that 3-5 year horizon, or the research rigor, or the dedication. So it will not come on a platter to somebody on an annual report or a con call transcript or a broker report. So yes, so again, one of the areas of investors to understand is the least spent area, which is corporate culture or management culture. Very few have been able to, but let me just share, if it was so easy to replicate something, McDonald's tried to create a pizza franchise in late 80s and it couldn't do it, even the might of McDonald's. And there is only one Starbucks in the world, even though it's just coffee. So I completely, and I think yesterday evening when we were discussing, just like there is only one Titan in the world and there's going to be no second Titan, no second Bajaj Finance, these companies who are able to create that operating culture, replicate it at scale, are so few and rare. Just to, since we have only 5 minutes, any particular industries, Utpal bhai, that you can share that you see where there is significant change in terminal value? There are so many new industries that are coming up, so many existing industries that are changing form. If you could separate that barbell into the direction of where you see getting value created and value getting diminished.
So, Varun, I think about it a little differently. To me, it is not the industry that creates value.
Oh,
It's the company that
Right.
creates value. And what happens is, in any emerging industry, that industry will go through an S curve. And during the first phase of that S curve, you will have a lot of people entering that industry.
Sure.
Okay? It is very difficult to find the winner in that phase. Okay? It's relatively easier to find the winner in the subsequent
Sure.
phase, right? Where you have the hockey stick, a part of the S curve. However, after that, you have the third phase, where that industry comes down and every weak player is shaken out of the industry. We find that you have the highest probability of identifying that great player in that industry in that third phase.
Sure.
It may not be the lowest price of that company, and which is why I continue to maintain that Berkshire Hathaway's acquisition of Apple stock,
Yeah.
even at
Yeah.
such a high valuation, so late in Apple's life cycle, but that outsized bet would not have been possible in the early days of Apple,
Absolutely.
right? So that is one more lesson for us. It's not important to catch the stock in its infancy. It's important to catch the stock when it is evident to you that this is a greatness stock.
It's crossed the chasm, so to say. Right. Absolutely. So there's nothing called missing out. There is enough time, and if the runway is that long enough, we will have enough time. Some closing note from you, Utpal bhai, would really help to guide everybody.
Okay. So first of all, Varun, thank you for those kind words. I would just say, keep learning, keep adapting, and keep investing. Don't be afraid of mistakes. embrace mistakes, protect your state of mind, and trust me, it's a journey which is very fulfilling, not just because you make money, but because you also learn. You become a better investor and a better person every day. All the very best to each one of you. It was good for me to interact with some of the youngsters here yesterday evening, and I look forward to more interaction today. Thank you.
Thank you for listening in to today's podcast. Before you go, please subscribe to stay updated on your favorite podcast app.